Hello, welcome to Accounting Hub. I'm Professor George Scarpin, and our topic today is notes receivable. What do we have here? Notes receivable, we have the creditor, lender. That is the one that we will be studying today because we are talking about notes receivable. If we were talking about notes payable, then would be the debtor. And we have the formal credit arrangements. And we can classify it as either current or non-current. Less than a year short-term notes, more than a year long-term notes. So less than a year current asset, more than a year long-term or non-current asset. What is the difference, guys, between notes receivable and accounts receivable? It is the interest. Notes receivable, we have interest attached to the note. Accounts receivable, we have no interest here, only late payment fee. Okay, so notes receivable, interest. Accounts receivable, no interest. And let's go to our Excel file. Excel file, all of our Excel files on Accounting Hub, it is free to download it. And to download it, only go to our video description. So let's delete it here, especially because these numbers are not right. So, Scarpin Corporation manufactures baby toys that it sells to retailers. On December 1st, 2020, the company sold shoes to Santiago stores. Scarping agreed to accept a 500,000 10-month 8% note. So percent here, interest. So we have notes receivable instead of accounts receivable. Interest is receivable at maturity, so only after 10 months, and the interest rate is appropriate. So here, the sales revenue, it is exactly the same. $500,000 here, notes receivable and sales revenue. What is our problem here? When we will receive it? September, October, November, December, January, February, March, April, June, May, June. So we will receive it on July 1st. However, on December 31st, we have a balance sheet. We are not working with cash basis accounting. We are working with accrual basis accounting. Some countries, this accrual is required monthly. In most of the countries, just like US, the accrual is required only when you will be presenting your balance sheet. So let's accrue this interest. How many months? September, October, November, December. 4 months. So here, what do we have? We are not receiving it yet. So it will be interest receivable and then interest revenue. So how much it is? 500 times 8% times for September, October, November, December. However, divided not by 10. This is the most common mistake. 8%. We are not talking about 8% per month, per semester, per year, per whatever. So if we don't have a specified period of time here, we consider that the 8% is annual. So divided by 12 instead of divided by 10. So $13,000 here, and the interest revenue is the same. Okay? We are receiving it July 1st. How much? $500,000 plus $500,000 times 8% times 10 months divided by 12. So we are receiving $533,000. How much will be our credits? Notes receivable, $500,000. And here we have it done. We have it closed. Interest receivable, 13. And the interest revenue, we have two ways to find it. The first one, the number to balance, and it will be $20,000 probably. However, we don't know if the numbers are right. So let's calculate it again. 500 times 8% times 6. We have 6 months remaining here divided by 12. So we have the $20,000 remaining. So if we do it here, we will have it 533. This is called interest-bearing notes. Why interest-bearing note? Because the interest is fully disclosed here. We have a second one, and usually we have it on the short term. So interest-bearing note is only for short terms. We have a third one that is the long term that we will also be working with. So non-interest, what is the difference? And let's delete it here. Okay, Skype Incorporation manufactures baby toys that sells to retailers September 1st, the same. We will be doing the same 500,000 non-interest bearing notes. So, okay, we have interest. However, we are not disclosing it. For delivering goods that have a cash sales price of 460. So okay, okay, Santiago stores. You have two options here. Cash 460, credit 500. So we have a interest here. We have $40,000 of interest. And then what do we have? We have a different sales revenue here. Our sales, so notes receivable 500,000. Sales revenue will not be 500 anymore. Here on interest bearing, it is 500 because this is also the cash value because the credit value is for 533. So our cash value now is 460. And we have a discount on notes receivable. That is a contra account of notes receivable. And it is the number to balance. So 500 less 460. Okay? And we will find it here later. Oh, we can do that. Oh, sorry. It is a credit. Man, the journal entry is not balanced. Yep. So here, discount on notes receivable 40. The interest rate here, how do we find it? It is sales revenue divided by, or discount divided by sales revenue. However, it is for 10 months. How do we find it for 12? Divided by 10 times 12. Usually we work with simple interest instead of compound interest. Compound interest is for long-term notes only. And the same here, December 31st, we have our interest revenue for month. So we have this discount here for 10 months. How much is for 4? Discount divided by 10 times 4. Much easier than the interest bearing notes. 16, interest revenue, 16. So now on December 31st, our balance sheet here, notes receivable, would be 500 less 40 plus 16. So on December, our notes receivable would be 476. Okay, we are on July 1st. Cash. Uh our cash here will be $500,000. That is how much we will receive. 500 is also our cash. Oh, is also our notes receivable. Sorry. And the discount. How much is the discount? Is the number to close our journal entry here. Or 40 divided at times 6 divided by 10. So it is 24. So we close it. And the interest revenue is the same, 24. So we can work here with one journal entry, that is what we have done here, or two journal entries, one cash notes receivable, the second one discount and interest revenue. So this is the non-interest bearing notes. What about the long-term notes? The long-term notes, we have a difference here. Let's, whoa, 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 whoa. Let's do it together. So it's just like a non-interest bearing notes. However, we have interest here. How do we do it? January 1st, 2020, Scarpy agreed to accept a 500,000 two-year note in payment for the toys, assuming a 12% effective interest rate. So we have 2-year note here. So our notes receivable will be $500,000. What about the sales revenue? The sales revenue, it is not 500 less 2 less 12% times 2. Long-term notes, we need to work with compound interest. And when we work with compound interest, we need to work with present value. By the way, we have a video about present value, so we will not be focusing here on how to do that. The video is in our video description too. Okay, so how do we do that? Equal present value rate. How much the rate? 12%. How many periods do we have? 2. We have no PMT because we will be receiving it at the maturity. And we have future value, that is notes receivable, negative 500. So we have it 398. And the difference is our discount. So just like the non-bearing note, non-interest bearing notes here. Okay, and let's work with the same format here. December 31st. So we have our first interest revenue. How much will be our first interest revenue? 398 plus, plus, sorry, 398 times 12%. So this is just like a amortization schedule here. And by the way, we also have a video about amortization schedule that we also have in our video description. Okay? And then the discounts to balance our journal entry. And now, what do we have? December 31st, cash, 500,000, notes receivable, $500,000. How much is the interest revenue? The interest revenue either is the number to balance to close our discount on notes receivable, and discount on notes receivable is also a contract out of notes receivable, just like the discount on non-interest bearing. So then number here is the number to close it, or let's calculate it. How do we calculate it? 398 plus 47 times 12%. So it is 53 here, and then the discount is 53 here, and it is right. Our discount is balanced. Okay, guys, that's it. This is not an easy topic, so please watch this video how many times you want and need, and go to our present value and amortization schedule videos as well. Okay, guys, so thank you. Subscribe our channel. You will be the first one to know when a new video arrives. Like our video, like our Facebook page, Accounting Hub by Dr. Scarping. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.